everybody, how's it going today? So glad you're joining us. My name is Steven, and I'm one of the managing partners and founder of Looking Inward for Tomorrow. We are a management consulting so the owners can keep trading. And today, what I really want to talk to you guys about is what does it take to become business lendable, right? So we started this series last month, and the goal today is I want to give you all the perspective of what a lender looks at, right? Because that way you can go to have conversations and understand what is the other person seeing when I come in? What does this look like? Like, how are they evaluating me? And so we're going to go over what we call the 5 C's of credit today. That's going to be very pivotal. Now, this is interactive. So for those of you who are here with me in the room, if you have questions, anything like that, just let me know. Raise your hand. We've got someone here. They'll fly around you guys to get those questions in, because my goal is to give you information. There is a ton to learn about the lending world. And I always put it in this perspective, right? If you go to your mechanic, you don't really want them to explain internal combustion to you, right? Like, when I push on the gas, it goes. When I push on the brake, it stops, and make sure that thing starts for me, right? That's what we really want to do. So what my goal is today is give that surface level, but put it in a way that it'll stick with you guys so that you can have meaningful conversations with your lenders. Cool? Now, before we get started, does anyone have a question or any expectation they came to this class with that they want to make sure is met? Whether it's like a particular question you had, or whether it was like, hey, you know what, I came here expecting to learn blank. Go ahead. Oh, hang on. Well, let's get the mic over there so everyone online can hear as well.
Okay, my expectation is to understand the lingo that they have when you going in, like the paperwork. You see the paperwork, they give you all these things, and you don't even know what they're talking about. And then what you're getting into. What do you have to look for? How do you have to, what do you have to pay attention on when you're actually going out there and seek a loan or talk to a loaner officer?
Okay. Perfect. So we won't be as much as in the, hey, here's the stuff we need, but I'll make sure to hit on that for you. But what we are going to do a lot into today is like what that lingo is. Like, what does capacity mean, right? Like, there's these 5 C's. What are they? And like, why does every business banker say, let's pre-flight? What is that, right? Like, so there's all these terms that we'll talk about today as well. So thank you for that. I appreciate it. Anybody else? No? All right. So let's go ahead and get started. So when you think about business lending, the easiest way to think about this is let's break it down into 5 C's, right? So we make it simple. Those C's are character, capacity, capital, collateral, and conditions. Now we're going to get into each of those in depth, and then we're going to put them together. And I've got a great resource that I'll send to all of you guys as well so that we can really put this together. But I want you to understand these terms out the basis, because when I work with clients and we're trying to find a deal for you, I'm literally calling up a banker and they're saying, well, talk to me about the capacity. Do they have any collateral? What's their character look like? AKA, what's your credit look like, right? You know, those are all conversations that we have before we even submit an application, right? And so those are important things to talk about. So we'll cover all of those, right? Think of this as a scorecard for your business. Right? So if I'm going to go get a loan, the 5 C's are my scorecard. And so what we're going to start doing, and Elias and a good friend of mine have been chatting about this, I also want to make this fun, right? So I've got some things here you'll see that we kind of put like a green flag, red flag, shall you say, right? Or like, you know, I like to think of it as the lending dating game, shall you say, right? This idea that just because a lender says no doesn't mean you're not lendable. And just because a lender says yes doesn't mean you should be taking that money. Right? There is a right relationship. And so I want you all to think of this like dating. The idea that when I go to a lender, I'm not just like there, hey, give me some money, right? I'm saying, are you the right type of person for me? Am I the right type of person for you, right? And that's what these 5 C's go into. So we'll hit on each of those case by case so you can understand that a little bit better, right? The first one I like to talk about is called character, right? Now, the first thing that character is represented by is your credit score, okay? So let's just get this myth out there. How many of you have heard that you can get business credit and you can do it completely independent of your personal credit score, and your personal credit score doesn't matter, right? Wow, I knew we'd have hands up, okay? That is false. That is one of the biggest myths that has been spread out there in the entrepreneurial community, right? The type of lending that is available to you without using your personal credit is not quality lending. It's very high risk lending. Most of it is what's called MCAs, or merchant cash advances. That is a payday loan for your business. When you start taking payday loans for your business, the only person that profits is the lender. Those are at 30, 40, 50% interest rates, right? So if you don't have a profit margin of 50% or higher, you should never take an MCA under any circumstance, because you can't afford to pay it back, right? So I say that because your personal credit will always matter. We're going to hit later where I talk about a triangle of success. There's 3 of these that make magic, where any one of those 3 can be enough to get you a deal. So if you take really great care of your credit, that could be enough for a business owner to get hundreds of thousands of dollars. As a matter of fact, I just did that like 2 months ago for one of my clients. They had 800 credit score and they'd been in business for multiple years, and they were in a significant cash crunch. Within 2 weeks, I got them over, I think it was like $400,000 of revolving credit instantly available that they could access as cash, based solely off their credit, right? So I say that because your credit can be a savior for you. It can be the destroying factor, but it's always going to come into play. And here's why. Your business does not exist without you, but you exist without your business. So when we look at a business, we have to identify who is the individual underneath this. And as much as we, hate it or whatever those circumstances are, if you've got things showing on your personal credit that say, I didn't agree to do what I promised, then they have to take that into consideration, because you are the deciding factor of that business. So the same person that made that decision there would be making a similar decision over here, right? So you've got to think of it like that. So your personal credit is always going to matter. So let's make sure that we focus on that, right? The other things that come into play are your reputation, right? So I'll give you a good example. I'm working with a lender, CRF, actually, the lender that we brought here a couple of weeks ago. And she said, hey, tell me about these entrepreneurs, because it's a business type and industry that they've never done before. And realistically, it's pretty high risk. It's book publishing. So if you know anything about book publishing, which I know basically nothing other than it's incredibly high risk and most of the people lose money, right? That's why you have these big publishers. They're interested in possibly doing the deal, but they want to say, tell me about these entrepreneurs. And I had the lucky fortune of saying, oh my goodness, guess what? This is like their 5th business. They turned their kids into internet celebrities so much they had to move out of California because the kids want a normal life now, right? And then you're like, wait a second, that sounds like an entrepreneur that succeeded before. They're probably going to succeed again, right? That speaks to your reputation. So if you're someone like me who has multiple businesses who have been running for multiple years, and I go talk to a lender about borrowing, they're already saying, wait, you're running that one? It's profitable. You're running this one? That's profitable, right? That speaks to my reputation. Then business type and industry is so crucial, okay? Here's a good example. If you want to get a restaurant loan, Wells Fargo issues more SBA loans to restaurants than almost anybody else in the nation. So if you're a restaurant where there's a lot of places don't like to lend to you, Wells Fargo's carved out a space for you, right? If you do contract lending, there's a few that are loving contract lending. Or if you're a contractor, right? There's different industries or different types of businesses that different lenders right? You go through all those questions, right? And that's what it's like when you engage with this. So when you speak to a lender, if nothing else, I want you to understand, you are interviewing them for you, not the other way around. I can show you how you can get money from plenty of people. You have to pick the right person, right? And that's what they're doing with you the entire time, okay? So that's kind of the basics of character, right? So character really digs into who is the underlying force behind this business and what does the business look like? Do we have any questions about character? Because that's just one, right? And so we got 4 more pieces before we start putting this puzzle together. Any questions about character?
Ladies first, ladies first. Okay, basically, what I wanted to know about it, if you have if you wanted to get a loan, let's say like a interest payment loan of some type,
okay,
where let's say you wanted to get a credit card, but you wanted to get money, like a credit card with so much money on, let's say like $20,000 or whatever.
Yep. Okay.
And how could you go about doing that as a personal loan, but yet be able to apply it towards your business?
So you can look at trying to get a business credit card, which would be the first step, right? Rather than applying for a personal card, apply for a business card.
Okay.
Right. So you can definitely do that. It's funny you guys mentioned that. I was just telling this before we started, right? So I had to file bankruptcy in 2018, got discharged in 2019. I've been structurally paying off all my debt before the statement date, not the due date. Today, it updated, my credit score jumped like 40 points, I think, right? So I finally went back around a 750. So last night, I couldn't sleep last night. Literally at 3:30 in the morning, I'm up searching credit card pre-qualifications, right? And I just started making lists of all the different ones. And I was like, okay, well, where am I at? Wait, I'm with Bank of America, been there for a couple of years, so I'm going to start there, right? I got a business credit card, a personal credit card from Bank of America, a business credit card, personal credit card from Capital One. And then I got one other one. I don't remember where it is off the top of my head because I literally submitted a ton of applications today, right? But the reason I mentioned that is you can be smart and structure around it. I know I'm doing that. Now I'm going to have a bunch of inquiries. I'm going to have a couple new accounts. My credit score is going to drop like probably 50 points, 60 points over the next 20, 30 days. And then it's going to take time to build back up again. But I needed to get more available credit because I have some certain things I want to do for my business, right? One of them in particular was a 0% credit card for like 18 months. And I'm going to pay off something else or cash advance it to a bank account and use it as cash, right? So that's a way you can do it. You can stack a bunch of them together. There are also companies that will actually stack it for you. The thing with that is, here's the danger of that, okay? Credit cards revert to 20-some% interest rate after that 0% year. So if you try and build a business on debt at 25%, you have to succeed immediately or the debt service will destroy your business.
When you say immediately, what does that mean? How much time do they give you?
Well, it depends on the credit card. Like the one I did, it was like 18 months. Some are as short as 9 months. Some are as long as 12. You still have to make payments along the way too, right? But you go from, hey, this was free to 25% interest rate on 20 grand, right? Now you're talking your interest is $5,000 a year. You're paying $600 a month in just interest, right? That will destroy your business. Yes, go ahead with your question.
I was going to pass it over. No, you actually answer it.
Oh,
Because, yeah, I was going after that one that you just said about the bankruptcy. So that's what I wanted to know about, like someone that was in business actually had to do that. And then you're saying that it goes with their character and who they are, that relationship. It tells you about your personal. So then how do you build to fix that in order to be qualified?
exactly, right? So when I filed bankruptcy, the first thing I did after the bankruptcy was discharge, right? So I filed in like October, it got discharged in April. Literally the day after it discharged, I went and I found the highest risk credit card lenders, and I got a credit card with each of them. I still have those credit cards today. I have one with Indigo, one with Mercury, and one with another, I think it's like Olo or something, right? They all issued me a credit card instantly out of bankruptcy. Now they all had like $300 and $700 limits, and I have like $100 annual fee on all of them, right? But what you have to do once you have a bankruptcy or something, is you have to start rebuilding again. So pretend you're 18 again and start the same way you got to when you're 18. Get some credit cards. Those credit cards that have annual fees and stuff, I've never used any of them. I've never put a single charge on any of those cards. I just pay the annual fee. I don't even know where the cards are, in all honesty, right? Because this is another myth. You don't need to use your credit cards for it to report on your credit every month. It's going to report no matter what. Now, the caution I give you is that some credit card issuers will cancel your card if you don't use it in a certain amount of time. That could result in lowering your credit score because you could have something on there, right? But you want to get started early and do a bunch, right? Like the reason I did 4 or 5 right now today, because that's going to hurt my average age of accounts, which is one of your credit factors, pretty significantly. So because of that, I want them all on the books on the same day. I don't want to do one now and then one 6 months later, because every time I add it, I'm adding a brand new card with a 0-month history against all my other accounts that have 4-year and 3-year histories, right? So that's one of those averaging things about it as well. But you got to reestablish. If you don't reestablish, then bad credit is worse than no credit.
So whenever you do a
I'm
sorry.
No, go ahead. That's fine. That's what I'm here for.
No, well, whenever you do something like that, you should always do like 3 to 5 cards or something like that.
I'm not saying you always should.
Oh, okay.
Right? That's something that I chose to do because I I
Is
started
it an
my,
advantage to do it that way?
well,
is it good to your advantage to do it that way?
for me it is, because I'm
No,
trying to get more capital
a
at
personal
once.
thing.
And well, and also this, I had to start my business out of bankruptcy. I couldn't get credit.
I see.
So I don't have business credit cards even today, even
see.
though my company's been existing for 4 years.
Mm.
So I want to actually help build up my business credit. So for
Mm.
me personally, I'm going to do that right now. You need to have self-control and make sure that you're responsible with it. And then, yeah, you can do that, right? But that's something that, you know, you got to look at it. Realistically, I say no more than 3 for most.
Okay, kind of like, if I'm understanding, my question was, why would you look for the highest of the interest to get those and get as many as you could? And then you're saying you don't use it, you only pay the annual fees on them. But then, as you said, when you have a credit card and you don't use it, and even if you're doing, they charge you so much and they build you even higher than the annual fee on it because you didn't utilize it. So how do you go about that?
So OLO, OLLO,
Mhm.
Indigo. None of them are in my wallet anymore. I wish
Yeah.
but there's another one. Actually, I could pull it off my Credit Karma here. Hang on. I know companies, there's 3 that I can give you right now that they do not close your account if you don't use it, and they won't charge you anything other than the annual fee. So I don't even get my statements for them anymore. You know how I know I owe a fee? Because my Credit Karma updates. I check my Credit Karma so much that I see every time a new card has a new balance on it, right? You should be checking your credit like every week, in all honesty. Right.
And doesn't it actually drop in scores when you are checking it and so forth when you're doing the
So
revision?
there's a
Yeah.
difference between a soft pull and a hard pull. Okay.
Okay.
So if you are like, the term I Googled was credit card pre-qualification, and you look specifically for cards that will allow you to pre-qualify on a soft pull. There's a ton of them. Capital One's a great one, right? Capital One let me get a credit card with them fresh out of bankruptcy, and I BK'd like 60 grand to them, I think.
Yeah,
Right.
their score is so high. They're
So that's why you start with the higher risk ones, or you go to like a JC Penney, a TJ Maxx,
Yeah.
and go get a department store
Yeah.
card, right? But yeah, you want to not use it because they have all these terms where it's like, oh, you used it. Well, even if you used it, we charge a minimum of $1 a month in interest anyways, right? So there's all those things that you have to keep track of. But yeah, there's those cards, you don't have to use them to report. And if you're paying an annual fee, you're typically meeting enough activity by making a payment once a year that they're not going to close the card on you anyways.
okay.
And then what I'm going to do, as soon as my average account's age is old enough, like probably 3 years from now, I'm going to close all those cards, because then I'll have enough other credit established that it won't hurt me and I don't need to be paying these fees, right? But I chose to pay fees to build my credit.
Okay.
Cool. Love the questions. All right. So that's one. Next, let's talk about capacity. All right. Now that's the first weird one, because you're like, what is capacity? So add these 2 words after it: to repay. So when the lender is saying, what is their capacity? They mean, can you pay me back? What kind of income do you have? So that could be, first and foremost, business revenues, because we're talking about your business, right? So any business revenues you have, they start at net profits, right? So that means, oh, this is hard, right? Because tax season, you know, everybody wants to write off as much as you can. And this is another thing, just like with credit, when I went and got a bunch of credit at once, I'm actually strategically paying a lot of taxes for the first 2 years of this, or the most recent 2 years of my company, because I want to go get a big SBA loan. So in order to go get a big SBA loan, that means I have to be paying profits, because the net profit is where the lenders start their calculations, right? Now, there are things that are called paper losses. So what I mean by paper losses is there are accounting functions on your taxes where you write off expenses, but it's not actual money out of your pocket. So examples of that are depreciation and interest. So if you are claiming any depreciation on collateral, or you're paying any interest on debt and you're writing that off on an annual basis, you get to add that back to your net profit number to increase your potential to borrow. So that's a good thing for you. There are also, if you have multiple entities, right? So for me, I have an S Corp. So if you guys know how S Corps work, we don't pay any taxes on that. You just get a K1. And then it gets distributed out to the owners. And I personally have to pay taxes on whatever my share of that K1 is, right? Well, because I have Lyft with other business partners and get that K1, when I go to borrow through my other business entity, IGS Consulting, I get to count that number on my K1 as profits, right? So we did pretty decent last year. So I have a number there. I'm like, hey, I'm profitable there. And then by the way, Lyft pays me a 1099, so I can count my 1099, right, of this company as income as well. And then the net profit, that all that came over to my personal one, whatever's left at the end is also more profit that I can add to that, right? So you want to think about that, like as business revenues, the top line is important, right? But that's not what lenders are really looking at. They're looking at what is your net profit. And if it starts out negative, that means you have to cover that negative with other income or assets and then still have more in order to qualify for the loan, right? Go ahead.
For me, can you elaborate a little more on what you just explained, but by giving an example, how you do it?
Yeah. So let's say you're a business and that you buy a car and you get a loan for that car because you're delivering pizzas, whatever. No one's going to do that. But anyways, right? The idea of it being is when you have that asset, you'll hold it as an asset on your balance sheet in your financials, right? And then you can claim a tax write-off where you say, hey, I bought this asset for $40,000. And you could choose, I want to do an accelerated write-off, or you could choose, I want to write it off over 5 years. And there's a portion of that 40,000 that you get to go to your taxes and directly offset against your revenues. So it would reduce your revenue by 10,000 if that's your depreciation for that year. So then that would be $10,000 that you would no longer be paying taxes on. But that $10,000 didn't actually come out of your account. It's the lost value of an asset that you get a financial accounting for. So that's what we mean by a paper loss. It's a number that affects your revenue on your tax returns, but it wasn't money going out the door, right? With interest, it's the same, just because if you're paying off a debt on something, you account for it a different way as the payment. So the interest gets double counted in essence, because you get to write off the interest and then you have the payment that already deducted from your expenses. So they add the interest back in. Now, if you go away from the big lenders and you go to like CDFIs, regional lenders, mission-based lenders, things like that, they'll also look at like your personal income. So they'll say, hey, do you pay yourself a W-2? Awesome, we'll add that in. Does your spouse work? Cool, we'll count their income. Do you have rental properties? Awesome, we'll count that income towards your business as well, right? You got investments, you get stocks, bonds, mutual funds, dividends, awesome, right? So I have some clients that we choose not to go to the big banks because they have a very like wide or unique income, and we want to take advantage of that, right? When you go to the big banks, they're going to say, no, I only run off what that business revenue is. I don't count that personal income, right? Sorry, that's great. That's what you use to pay your bills, but that's not the business. But when you go to these CDFIs, which are just lenders that are there to make the loans that the banks don't want to make, they're nonprofit organizations, they make those deals all day, right? And I've done tons under that capacity. So there's also a cool thing where it's like we did one where the spouse had really bad credit but really good income, and the other spouse owned a business. So we're using their income but not pulling their credit in order to get the deal done, right? So there's cool ways that you can work with individuals when they're mission-based. And we'll talk about what that means, okay?
I just wanted to ask you about that, because I know you said you were an S corp.
Yes.
What is the best advantages to that? Because I'm an S corp as well. So what are
I'm going to say I'll answer that after for twofold. One, not online with what we're discussing today, and two, I am not an attorney, so I am not the most qualified individual. So I have to give you disclaimers before that. So I will answer that after the class today. Okay. So capacity, we've covered one half. We've covered what's coming in. Now there's this whole other half of what's going out. And this is something that frustrates entrepreneurs, because when I'm trying to run their numbers, they'll send me all their tax returns, their business plan. But then there's this one form called the personal financial statement. And it's only 6 pages. You think it'd be fast, but you literally have to log into every financial service you own and put down balances and payments and all this other stuff, right? Well, I can't calculate whether or not you can afford a loan till I have both halves of the picture, right? It doesn't matter how much you make until I know how much you pay, right? Because I work with entrepreneurs that are doing millions in revenue, right? Like I have one client, when I met them, they're doing 10 million in revenue. And when I met her, she said, hey, I don't have money to hit payroll in 4 days, right? So just because you make a lot of money, right? Like bigger money, bigger problems, right? And so you always have to think, what are these two sides, right? And so the liabilities, you have 2 different types. You have short-term and long-term, right? Those short-term are your credit cards, vendor payments, your accounts payable, if you have lines of credit, stuff like that, right? Your long-term liabilities are going to be more of those fixed assets. Did I buy a building? Did I get real estate? Do I have an SBA loan with this because I had to, fix a building that I don't even own, right? Or did I buy a ton of equipment? Those are going to be all those long-term liabilities. Now, the way the lender looks at it is they just go off the monthly payment. So we take all your monthly payments and then we annualize that number, right? So if you have a total of $1,000 a month in monthly payments, then your annual debt service we need to cover is $12,000, right? But that means we have to actually have like $14,200 in actual profits to cover that debt service, because they don't want just 1-to-1. They need 1 to 1.15 or 1 to 2.5. So that just basically means for every dollar of debt that you have, you need to be showing you're making at least $1.25 of profit, right? And that's through the monthly payments. And then depending on who you work with, sometimes you can run into situations where we can actually write off one-time expenses. So the very first deal I ever did as a fresh entrepreneur, right? So I left US Bank and started finding clients. And the very first deal I ever got done, we got done because I was able to use a one-time exception with CRF that no one else would do, right? So this was it was a cheer. So CRF is it's a CDFI, a Community Development Financial Institution. So they're an actual lender. And I brought them here a couple weeks ago, so that's why I was kind of mentioning them. We did this presentation together, but they're mission-based. So they like lending to women, minorities, and veterans. So obviously, we have a community here that is exact their demographic. So I was like, let's connect these people, right? And so that's what the goal was with that one. But they're just a CDFI. So think of them as a secondary lender that we can go to when we don't fit in that perfect little box for the banks.
So can they give you better discounts if you're MB?
You're not going to get a better discount. You're going to pay a higher rate with a CDFI, right? But it's going to be an easier process, and it'll be a situation where you get the deal versus the big banks just won't even do your deal, right? So it's more like, can I get it done versus not? Medical is always, so when we go back to that character, everybody loves medical. So you're good in that one, right? You're already like, hey, everybody wants anyone who's got any kind of physicians, certifications, nurses, all that whole gambit, anything in that medical space, most every lender likes, right? Okay. But so back to one-time expenses, I was helping a cheer gym, and it just so happened they bought new uniforms that year, right? And so that cost like 50 grand. And that was like, okay, that hurt our profits pretty bad this year. And all the other lenders were like, well, because of that, you don't cash flow. I had a deep conversation with you guys. I'm like, listen, we did this, but we only do this every 3 years. So why don't you not debt service us for $51,000 and instead debt service us for $17,000, which is fair and realistic, because this is a charge that only happens once every 3 years. And we were able to show them prior financials to demonstrate that. See, last time we did this is when we started our company, right? And by doing that, we got them to now increase their lendability by $34,000 a year of debt service ratio. And that was enough to get the approval, right? So this is why there's no cut recipe. There's some ways that have led to success, but every deal is unique, right? And that's why you guys have so many questions, because you're like, wait, I got this little nuance, right? Or I have that little nuance. But that's capacity, right? So with capacity, we're just thinking, what's my capacity to repay? What's my income look like? And what does all that debt look like? Next, we got capital. This was pretty simple, right? What do you have as cash in the bank? That's the number one thing everybody thinks of, right? When you think of capital, they're like, okay, what do I got? My personal accounts, my business accounts. SBA started a new thing this year. So if you have a home and you own your home and you have a home equity line of credit, you can use whatever available credit you have in your home equity as your cash injection or your capital injection to a deal. Now, that's very important because with an SBA loan, you are, as a startup, you're required to have anywhere from 15 to 25% of whatever you want to borrow as cash in the bank, right? I want 100 grand and I'm less than 2 years in business. I'm going to need at least 15 to 25,000 of cash in the bank in order to get an SBA 7A loan with any lender, right? Because that's just the SBA requirements. But there's other things that can count as capital that sometimes people don't remember, don't think about, right? So you've got investments. So if you've got a 401k, if you've got IRAs and you're under 59, they'll do some kind of discounting to count some. If you've got IRA or retirement assets and you're over 59 and a half, they'll count dollar for dollar as that as potential capital. There's also like business equity. So if you do any type of retained earnings for your business, you have assets that are owned, or if you've invested money. So for instance, here's a great example. My company, we're going to finally start our nonprofit. That was what we really wanted to do when we started anyways. And the first step we're going to do is we're going to lend in the Philippines, right? And so we already do lending here. We know it, we understand it, and we've seen a huge need over there. Well, we're going to take money and we're going to invest it over there, and it's going to be generating return, right? But it's going to be held in a weird balance sheet in a separate entity, but it'll still be my business asset that is operating. So that's my equity, right? There's other ways that you can do that to try and generate income, right? And then lastly, you have business assets. So everybody thinks of the normal stuff, right? Like the building, the oven I did to bake the pies, or the massage table I use, right? Like those are the obvious ones, right? A lot of people don't understand that if a bunch of your clients owe you money, or like you work on a contract basis, that's an asset for your business, right? So like I work with plenty of clients, like for instance, in the construction industry, where you have contracts that you sign, but it takes you like 12 months to fulfill this, right? And it could be like $1 million contract, but you get paid in stages, right? All that money that's owed to you is called accounts receivable. Lenders will allow you to leverage that typically up to 70%. So think of that. If you had clients that owe you $100,000 and you're running tight on cash, the fact that they owe you is now capital, or in essence, it's also collateral too. So it hits too, right? That you could say, hey, I can use this as potential for borrowing, right? The other thing is right now, all of you are in physical contact with the inventory of Nevada Partners, right? This desk, these chairs, everything you see here is equipment of a business. And it could be, if it was being resold, it would be inventory and it's an asset. If it's not being resold, then it's their equipment and it's an asset. But either way, it's an asset of the business, right? But if you're not accounting for that and you go to lending, they won't know like, oh, wait, you've got $20,000 worth of equipment, which is $20,000 of your own equity and your own assets in your business that I might be able to leverage as needed for lendability, right? So I always mention that because you have to talk through with the lenders about what does my capital look like? What are some other things that you may want to use in that capacity? Because it can be so crucial as identifying how do we make this from here to approved, in essence, right? Any questions about capacity or capital?
Okay, based on what you were saying, the part when you said that you can use, like, let's say if you have an asset like your home, you use the equity.
Mm-hmm.
Isn't it that you should not use that? Because when you actually draw it or take it, you're putting yourself back into zero, into the home, and then you end up paying more for this house than what it was worth it at the beginning?
So if you have an asset that is paid off and you lend against it, you will have to end up paying interest against that, right? So it would result in more, but you need the loan anyways. So if you go get it somewhere else, guess what? It's not going to be tax deductible potentially on your personal, as well as a good interest rate, right? A home equity is going to be a lot lower interest rate than anywhere else. So what we see some entrepreneurs do is they make the choice to use the cheapest credit available to them to grow their business, rather than saying, hey, I'm going to go get business credit, right? Now, what I was talking about with the new SBA is you would just go set up the line of credit. You don't actually have to use it or pull it. But by having access to it, they would say, okay, we'll count that as your 25% cash injection.
Okay.
So you could, if we need you to put it in there, you could advance it out, right?
Okay.
Owning a home is the gateway to wealth, right? The rich become richer by leveraging their assets. So what I would actually say about that is I want to challenge your entire thought process, because there is good debt, right? And there is bad debt. And the wealthiest people in the world use the debt like crazy. So I spent a decade managing money for millionaires, right? Literally, I have tons of clients in the city that I was working with and I was managing their money, right? And when you work through that and you see how they do it, they would go and have like 5 investment properties and go get what you call a collateral loan. So they're all worth, let's say, $1 million just to make it simple. So now they've got 5 million worth of homes. They wrap it together as one. They go to the bank and say, hey, I want one of your collateral loan products. Right? And they're like, oh, cool. Come on, let's chat. You got 5 million worth of homes. We're going to bunch them all together. I'm going to cross collateralize everything. So I'm going to take it all as collateral and I'm going to give you a line of credit of what it's worth 5 million. They probably give you somewhere around 3.5 million at least on that. Right? And that's a really good interest rate. So as a wealthy person, I'm going to go use someone else's 3.5 million. Even if I pay interest, I don't care because it's not my money. I'm using someone else's money. Well, take that 3.5 million. I'm going to go buy a distressed commercial property. I'm going to work with someone to build it up, increase the rents. I'm going to buy it for, let's say, 2 million. And after I rehab and update it, I'm going to be able to sell it for 3 million if I choose to. But I'm not even going to do that because there's a 10-year depreciation that I can use. So I want to get all my tax benefit first, and then I'm going to sell it. But after I buy this property, now what I do is I've stabilized it. So now I refinance it and I go get a traditional business commercial mortgage on that property and pay off my line of credit. And I just rinse. What do we do? Repeat. You see what I'm saying? I saw this repeatedly. Now they do it with their homes. They do it with their investment assets. So they're like, oh, by the way, I have 10 million invested with you guys. Cool. Let me get you another $5 million line of credit. Bam. And we were throwing those things out at subprime at like 2% when I was in private banking, right? So you would get 2% to go buy a building. And they were just like, why do you think we saw so much separation in the wealth gap during COVID? Because everybody who had assets and was smart about it multiplied them. Any of that didn't have assets didn't have that opportunity, right? So what I say is the thought process there, like there's good debt, right? But you got to be responsible with it. Absolutely.
Okay.
Cool.
You just answer it. That's why I start laughing because before I get to ask the question, you answer it. Okay. Yes.
Awesome. I've done this for about 15 years, give or take, of just like the lending. We're like, ever since I went into private banking in 2012. So what, 12 years? For the last 12 years, I've done nothing but eat, sleep, breathe, and live financial services and lending and wealth accumulation. And so because of that, I got really good at it. And then the last few years in particular, all I did was business lending because my good friend Morris, who's my business partner now, recruited me. So I was like, okay, I'll go sling some business loans now. All right, so let's talk about collateral, right? Collateral can be a big, important deal, right? It can be crucial to a deal. But SBA rules also state that lack of collateral is not an acceptable reason for decline. So what that means about collateral is if you don't have collateral, that does not mean you can be declined. Now, if you have collateral, it is more likely you can be approved, right? And also, depending on how much you borrow through the SBA, if you go over 500,000, SBA rules require them to grab any outside collateral available in order to secure up to that loan amount. So why do I mention that, right? So for my doctors and the people in that medical profession, typically they've done kind of well for themselves, right? And so I'll meet a doctor who's maybe 3-5 years in, practice is running really, really well, and they want like $500,000 or something to grow their business, right? If they go to a traditional bank, they'll get the loan, sure. But then those investment properties they have are going to get a lien on them no matter what. I have a couple CDFIs that I work with where if you stay under $500,000, they won't even look at your personal assets. They're like, oh, cool. We don't go after collateral. And what's really cool about that is you have to understand how SBA works. Okay. So SBA is not a lender. They are a government agency that supports the lending process. So SBA makes a big box like this. Okay. Here's the box. And they say, you can operate all the way out to the edges anywhere you want in this box. But the SBA also says, you know what, lender, you also have the right to operate anywhere within that box as well. So the big banks are like, cool, because I'm not lending this much risk. I'm right here. This is your Wells Fargo's, your Bank of America, all the big banks. They're like, no, we go right here. Oh, and we like this because, there's medical there. Oh, and we like this because it's got collateral. And we like this little spot here because it's, but that's all they lend to. You go to a CDFI, right? So why do I keep talking about CDFIs and why is this so important? When the Community Reinvestment Act came out in like the 1930s with all the redlining and everything that was happening, it was the government's attempt to try and reappropriate, right? As we know, it didn't work in the long term, but what it did is it put accountability on these lenders that were saying, hey, I see you've got a branch there, but I see you don't lend to anybody in that community and you don't invest in that community. So this CRA Act requires you to do that. Well, banks being banks, having all the money and having all the lobbyists, they said, oh, we can fix that. We're going to go to Congress and get this lobby to have new organizations created because those loans are too risky for us and we just can't make them. I can't make them and still pay these shareholders a profit. The two just don't work out, right? So instead, banks give millions of dollars to nonprofit organizations called CDFIs, and the CDFIs make those loans, right? How many of you guys have heard of Access Capital? Okay, so Access Capital is a local CDFI, born and raised out of Las Vegas. It's the only one. We are a lending desert, right? But they got a big loan, they got a big investment from a bank, right? They got 5 million from a bank to get started and up and running, because they say, hey, you're going to be lending to minorities and everything. And then the bank that gave it to them was like, cool, I just met my CRA initiative for the city of Las Vegas, right? Now I just got to do it across the rest of the nation, right? And so it's a way for them to reappropriate. So I work with the CDFIs for 2 reasons. 1, they'll do deals that the banks won't. And 2, a lot of them are mission-based. So we can go like, I've got deals done because they were like, hey, we have a really healthy balance sheet. I'm a mission-based lender, and that's a minority serving minorities. I want to do that deal. I literally had CRF come to me like, we're going to do this deal. I'm like, really? I sent you 4 deals today, and that's the one you picked? I'm like, what about this one? It's got all these profits and revenues. She's like, no, we don't want that one. And I'm like, right, it's funny. So you just have to run through those. But collateral can be your real estate, can be anything owned by the business that has potential value, and then anything owned by you personally that has value. Now, when it comes to pledging collateral for a lender, that's typically going to remain to properties like real estate and assets like investments or other stuff like that. They're not going to go after cars. They're not going to put a lien on any personal properties, like, oh, I got this jewelry at home and stuff, right? They're only going to want to look at assets of like cash equivalents is what they call anything that can be turned to cash within 72 hours. And then real estate are the only things that the banks are really looking at as like, hey, we have to grab that outside collateral. Questions on collateral? We're almost there. That's 4. So this last one is the most difficult one for borrowers. And it's the most frustrating one, right? Because it's the idea that's like, when a lender approaches you or you approach a lender, they're like, okay, cool, get me these documents and I'll let you know if we can do the deal, right? Well, the problem is they don't know what they're going to see on those documents. And so every lending decision is like this daisy chains of if-else conditions. If this, then I need that. If this, then I don't, right? And there's just this daisy chain of every single box that's on your tax returns in essence, right? So they don't know if you've got an investment property if you don't tell them in advance. So you send them your tax returns, there's an investment property, then you get mad because you're like, okay, I sent you all my documents. Like, actually, I need a few more now, right? And so it's this idea that the conditions that they create in order for you to get the money, right? Now, there's a few things that can help with this process. Number 1 is what I called pre-flight. Okay, so if you've never heard that before, write it down. Anytime you're looking for business lending, you need to talk about pre-flight. What that does is you get all your packet together, all the financials you need, and you provide it to a lender. And you say, lender, assume I have the credit you need to approve me. Look at everything else and tell me, will you do this deal? Yes or no, right? They don't do a full underwrite, but they'll take it to credit committees. Like the companies I work, we either get 2 credit committees or we get an LOI, what's called a letter of intent. So you show them this through a pre-flight, then they say, yeah, we like this deal. I like it so much. Here's a letter telling you what kind of terms I think I would give you on this loan, right? You can pre-flight anywhere, everywhere with as many as you want. So when I work with a new client, I'm typically pre-flighting anywhere from 3 to 5 lenders, depending on the deal. Sometimes I just know, hey, we're going here because of, A, B, and C of your personal situation, right? But you want a pre-flight. So anytime you engage with a lender, ask them, what's your pre-flight process? What do you need from me? And how long is the turnaround? All right. Most of them get it done within 48 hours. Okay. The other thing you do is you just be transparent in the process. Okay. I'm going to show you something of how this all comes together, and we'll see how then we start measuring ourselves and determining where we fit on there. But I can tell you the other way you can affect your character in the lending process is not properly disclosing information that should have been disclosed at an appropriate time, right? So that could be something from, oh, I've got this issue with my business that I don't want to tell you about, and I hope you don't see it in the financials, to, oh, anything, right? You just want to make sure that you're very clear and transparent. And here's why. If you're not clear and transparent, you could go through the lending process, and 45 days later, when you think you're about to get your money, guess what they do? I'm sorry, you're declined. Right? There is nothing worse than a long no in the business lending world, right? I exit lenders out of my book when they do that, right? I was going to throw an explicit in there, but we're recording. No, the idea is because for me, pre-flight is where that has to happen. And I actually have a lender that I went off on like 3 weeks ago because they knew the experience of these individuals, their resume, from day one. And 45 days later, they said, well, our underwriters decided they didn't want to do it because they didn't have a strong enough management experience. And she apologized profusely to me, the individual that I work with, because she knew that, like, you're getting toward a new one right now, and don't expect any referrals from me until I'm done being mad at you, right? But you can't waste my client's time, right? And you can't waste your time. Your time is best spent investing in your business, or working on your business, or working in your business, or training people, right? There's so many other things you can do. So just be transparent in the process. If you got issues, cool. Give them your issues up front and let them say no right away so that you can go find the one that's going to say yes, right? And then lastly, there's this compliance process, right? So a little bit about how the process works. You'll do a pre-flight, right? Once you do pre-flight and you get an LOI and you find someone you like, you're going to pay a good faith deposit to them, right? So yeah, when you want an SBA loan, you get to pay them to underwrite you. Isn't that fun, right? But you have to pay those third-party fees. So they take a deposit from you on the front, then you enter underwriting. Depending on the lender, that could be as short as 2 weeks. That could be as long as 4 or 5 weeks of an underwriting process. There'll be back and forth of documents. There'll be an interview with underwriters through that process, right? But then they'll get to, hopefully, an approval. Now, once they stamp that approval on it, now you start going through what's called a compliance process. So this is why the SBA is so powerful. When you make an SBA 7A loan to any of the SBA lenders out there, they immediately grab all those documents, that papers and everything you sign, and they run to the SBA and they say, here, I got it. SBA says, yep, all these boxes are checked off. That makes good. Check. Here's 75 cents on the dollar, right? So the bank just made a $100,000 loan to you. They got paid $75,000 back as soon as they sold it to the SBA, right? They can't sell it to the SBA if every single box isn't checked and every I is dotted and T is crossed, because they actually have a certain amount of exceptions that they are allowed, right? But if they make too many exceptions, then they can go over a percentage amount that they're allowed and get kicked out of the preferred lender program. And that can be a big problem, because if you're not a preferred lender, then you can't underwrite your deals first. You have to underwrite it and then send it to the SBA to underwrite as well. Whereas if you're a preferred lender, you underwrite it and you just send it to the SBA to stamp a loan number on it. So it's a completely different process. So with that in mind, also, I strongly recommend only work, if you're going to do an SBA loan, work with an SBA preferred lender, right? If they're not a preferred lender, it's going to take longer to get the deal done. And the ones that weren't preferred lenders had all kinds of issues. Anybody hear about Fountainhead during the 2020 thing? Like, Fountainhead made a ton of loans, and PPP loans in particular, throughout Nevada, right? Fountainhead went out of business, right? They already went bankrupt because they couldn't even make PPPs right. And that was free money, right? So I mentioned that because when you're not compliant, the SBA kicks you out or you'll go out of business. So they have to be compliant. And it's that compliance that drives you guys freaking nuts, right? Because you're like, okay, I provide all these documents at pre-flight. Then I provided more documents to start the underwriting. Now I'm providing more documents at closing. Like, the document process never stops, right? That's because we're working with a government agency, right? That's the bad part of the SBA, right? But the good part is it incentivizes the lenders to make the deals, right? Okay. So let's talk about how we put this all together. So I have this on a one-pager, and I'll make sure that I'll send it out to all you guys. I just need to get email addresses, or I'm guessing Elias probably has them. But so what I created is our 5C star. And there's a star in here, and there's also a green triangle. We'll hit the green triangle next. But what I want you to see is when we talk about character, collateral, capital, capacity, and conditions, they all have a very intentional place on this star, okay? The reason we have character at the top is because that involves your credit and reputation. And as I told you at the start of this, if you have impeccable credit and a good reputation in this industry, that could be enough to get you the money you need to start your business or grow your business, just that alone. Of all 5 of these, without going to high-risk lending, that is the only one that can stand on its own and get you a deal done by yourself, right? That is why personal credit is always going to be so crucial, right? So you have to think of that, right? Now, at the base of this, you see capacity and capital, right? So those are the 2 foundations to get a loan. Capacity is what's your cash flow or income, right? Because the number one thing a lender cares about is, can you repay this loan? So that's why capacity is here. Capacity on its own can be enough to cash flow a deal, but here's the problem. It's going to be a high risk deal typically, right? Because, or if you've got at least decent enough credit, then you could still, right? Like I have someone who we literally got a credit exception because they were sub 650. So if you're not 650 or higher, we have to get an exception to get an SBA loan, right? It happens all the time. So that's one of the easy exceptions. But if we're going to make an exception on your character, do you think we want to make an exception on the capital and capacity too? No, right? That's why those make a triangle. So when we talk about that green triangle, we'll talk more on the next one. Those are the three that you need at least one of those if you're going to get your deal done. If you don't have one of those three, you may be wasting your time trying to seek lending. Okay. So the capacity could be, hey, okay, my credit's a little hurt, but it's at least, it's close to 650. But in this case, you know how I got it exempted? Because I was working with an entrepreneur that paid 6 figures profits, reported them every year. So he's paying like 40, 50 grand in taxes every single year. I'm the one person that is so, you can get so happy when you say you pay a ton of taxes every year. Because when you tell me you pay a ton of taxes, I'm like, cool, that means you have a ton of profit you claim as a business. So I'm going to make that worth your while now. We're going to get you a loan, right? But a lot of people choose to make the difference where you're like, hey, it's tax time. I need to write off as much as possible, right? So you have to know when tax time comes and you're making that decision, you are deciding, am I going to make my business lendable or not, right? And so if you ever want to have a conversation, I do free consults with everyone. I'll sit down with you and chat. Where are you at now? And if you're not lendable today, we'll talk about, hey, take these steps and meet me this day, right? Do this. And when you hit here, meet me this day, right? Someone in the room can attest to that. Lastly, you talk about capital, right? So capital potentially can be enough to get your deal done as well. I had a retired couple that wanted to start a food truck, right? And they had some income, yes, but they were going to both quit their jobs and they'd have Social Security. So there was still other income. But you know what they had done? They'd both been very high income earners and they had over $1 million saved up in their IRAs and they were over 59 and a half, right? Now, here's the thing. You cannot bankrupt an SBA loan. Okay, when you get an SBA loan, there is no getting away from this. You will either repay it or the IRS will be after you forever and you will never get another government loan in your life or a tax return in your life until those things are paid, right? So it's a government loan. You don't get to play around with that. Because of that, they feel perfectly comfortable to lend a few $100,000 to someone who's got $1 million in retirement if you're over 59 and a half, because they know you can't bankrupt it. And they know you've got the assets, so they could just garnish you if they really needed to, right? So again, those are ones where it could potentially, but what I strongly recommend is when it comes to capacity, capital, and character, you need at least one. If you feel you are strong in two of those, then you definitely have potential to borrow, right? Now, this is why I say just because a bank said no doesn't mean you're not lendable. If you go to any of the big banks, they're going to say you must have 2 out of 3 of these or don't even talk to me. Right? So character, capital, capacity, they want 2 out of those 3 to be solid and strong, or they're going to be done talking to you. They haven't even got to the conditions or collateral yet because those are secondary, right? The conditions are what am I expecting of you? So those are reactory, right? And collateral is on the side because, again, remember what I told you about collateral? It can't be used to decline you. Just because you don't have collateral, they cannot decline you because of lack of collateral. And if anyone ever declines you because of that, please come find me because I will show you how we go after them, right? I did it with someone actually, and I got someone fired at a lender because we had it on recording. And I'm like, wait, you're literally telling me I'm declined because I don't have the collateral? Yes, that's exactly. Great. I want to speak to your supervisor immediately. This call is being recorded, isn't it? Great. Thank you. No, I'm done talking, right? And I just went right up the chain because I know the law. But the point of it being is, that's why they're on the sides, right? Collateral conditions, they're going to come up, but those are more the things that come up through the process that we can work through, right? Those other 3, they make up what I like to call the triangle of success, right? So if you have all 3 of these, then you get to choose who you want to be your lender, right? And that is the most fun, right? So I told you about how I had a borrower who was able to get a whole bunch of credit really fast because they had really strong credit. Well, here's the other thing. they had really good capacity showing, at least because they had a ton of revenue coming in. Now, don't get me wrong, the financials were bad, so we didn't want to show anyone our balance sheet or our profit and loss. So we just identified lenders that operate solely on character. Who's someone that's not going to request a financial review? They don't want to see all my documents. They're just going to have me submit a credit app and make a decision. So Chase does up to 150K. First Citizens does up to 150K. Amex does 75. I can go on and on. There's First City National, they do up to 100,000. Bank of America does up to 100,000, right? Most other banks will do up to 50,000 too, right? So you can actually go credit stack lines of credit if you've been in business for 2 years or more, right? As a new business, just get it out of your head. You're going to get a line of credit. I know you want a line of credit. Everybody wants a line of credit. Who doesn't want a blank check? Those things are amazing. I love a blank check, right? That represents the most risk to the lender. So understand that and say, hey, when I'm at my riskiest as a new business, I'll just take a loan because it's less risk for you. And I know that's what I can qualify for, right? Once my business is established 2 years or more, I've got revenue coming in. Now it makes sense for me to get a revolving debt, right? And get a line of credit, right? But also as a new startup, you're not going to have the revenue to pay that back. Revolving debt should be paid within 90 days maximum, right? There should not be a single charge you put on a business credit card that isn't paid off within 90 days. And realistically, it needs to be paid at the end of the month. And if it's not, that just means that's not a charge that goes on a credit card, right? It has to be paid for out of other operating capital because you're paying a longer term debt or a longer term need with a short term credit obligation. And that's what lenders call credit matching. So determining on what you're going to use the money for, lenders will determine whether that should be a line or a loan. And they will actually force that to you. I have one right now. We went to him and we say, we want a line of credit. This guy's blowing up. He literally went from 300,000 a month at the beginning of the year. He's already doing over $1 million a month this year, right? Just exploding. Been in business 5 years, has great credit, has everything you need. So we could easily go get a line of credit. But then we start talking about what we're going to use it for. And because we're going to like refinance some debt or maybe buy some more equipment, those are all long-term things. You don't use lines of credit for that, right? And then payroll is typically a short-term. But if you work with a lender and they're like, well, you're going to do a one-time pay increase or you're actually hiring 5 positions and normally you only hire 1, well, that's an out of normal growth, which you typically won't be able to immediately support in 30 days, right? You're going to need to build revenues over 3-6 months in order, because a new employee doesn't come in and start producing revenue. We hired our first virtual assistant or our first executive assistant over a month ago, and she still hasn't generated revenue for us yet, right? Because it takes time to learn your company and like get people in process and do all those things. So a big increase of labor or a growth like that is actually considered a long-term expense because you need to pay that off over a 12-month or a 24-month period just to be able to afford that growth as an entrepreneur. Okay. So I mentioned that because if you have all 3, you can pick where you want to go. And it's really great. It's fun like that. You can actually get like 4 or 5 letters of intent and make decisions based on who's giving you the best rate, who's going to give you the easiest conditions. On those letters of intent, they give you a list of all the next set of documents. So one of the things that I do for my client, like the clients that have all 3 of those, I'll shop multiple ones. Because when I go to like a big bank or a regional bank, I'll get 3 pages of these are all the extra documents you need. When I go to CDFI, I'll get like 10 items, right? And so what do I want my transaction to look like? And that is something not a single entrepreneur ever thinks about, right? You don't go to think, be like, what do I want to have a headache this entire time? Do I want to have to give 1 billion documents, or do I want it to be simple and easy? And because of that, I'm willing to pay 0.5% or 0.25% higher, something like that, right? Those are decisions that when it comes to business lending, it makes a lot of sense to do it, right? Because they're like, hey, okay, I pay a little bit higher interest rate, but this lender made it so easy that I don't have to worry about that, right? So there's give and take in all those areas. So I've got my info up here. So if you want to take down my info, if you have any questions, we're actually building out a lending tool. I don't think it's live yet. So that lending.liftnew.com is not fully up and running yet. There is a form you can put there, but the calculations aren't running out yet. But if you have questions, you want to chat with me, I'm more than happy to meet with anyone one-on-one. So I will provide free consultations to anyone and everyone. And here's the other cool part about our organization, right? So because we are established and we've had a good couple years, we used to have to charge retainer fees on the front end. And I hated that, right? Like you already got to pay these lenders a fee, but as a new entrepreneur, I have to be smart. And if I'm not making money until these loans close in 69 days, we had to charge fees. We've restructured our pricing now. So we have 3 different ways we work with individuals. One is free. You think you could do it yourself? You don't need my help? Awesome. Let me just talk with you and find the right lender for you, and I'll connect you, right? You go on your way, you get it done. If you want our help, you're like, hey, I want your mind on this. I want you to look at all my documents, give me advice. I'll change them and I'll make all the upgrades. I've got all my documents though. Then we do that as well, right? And that's the way you can work with us. We charge $1,000 fee. Or we have our, let me say, basically we do it for you. We'll create every document we need. We'll negotiate your lending products. We'll be on every underwriting call. We'll do everything you need for it. And we charge a $2,500 fee for that. Here's the best part. You don't pay a fee if you don't get loaned. Right? So if I cannot get you approved and get your business funding, then you won't pay a fee. And as a matter of fact, that's why we have this free consultation, because if I don't think I can get you lending, then I won't even take you as a client. But what I will do is I'll say, here's some steps and resources. By the way, I'm a SCORE mentor, so maybe come over here. Let's do some mentoring together. Or by the way, I've got this other resource for you. Or hey, you know what? You don't need a loan. Do you know what you need? You just need a client. Let me introduce you to someone. I did that for a company in the TBI here that we actually were just chatting before this class. She's like, thank you so much. Like, you don't understand. I'm like, I do understand what it's like to have recurring revenue. Trust me, I'm a consultant. I remember my first client I got on a monthly retainer, and it was a very great feeling, right? And so I mentioned that because we're here to help. So if I can't find you lending, I don't believe I can find you lending now, I will help you get on the path to where you are lendable. All right. So you've got my information up there. I got a little couple case studies. So I want to go through one of them here. So when you look at this, what we've done, or what I've done here, is kind of rated all of these. And I do have this client's permission, so I'm not using any numbers, but this is one of my active clients. And so we decided to do green flag. I'm going to change it to where it's going to be like green flag, red flag, right? Because that the whole dating thing we talked about, right? So think of it this way. When you're getting an SBA loan, that's dating for marriage. You have serious intent here. That's a 10-year term, right? We're not looking, for situationships, anything of that sort. This is real, right? And that's why there's all the paperwork. It takes a longer process, right? But if you want a high-risk loan, you can get an application in 3 months bank statements, and I can get you funded in 24 hours. So, I mean, if you're in the hookup culture, then MCAs are all you, right? You get what but do you want to take that risk with your business? Like, I don't take that risk with my body. I don't want to take that risk with my business, do I? Right? But now it clicks, doesn't it? And that's so when you look at this, let's talk green flag, red flag. Okay. So here's what with this business, they had -7 figures on their profit and loss. Okay. You're losing hundreds of thousands of dollars every month. And that was their 2023, right? But we actually have them even on capacity. That's really weird, right? Because that should be a big old X there if they were negative that, right? Well, the reason for it is because of conditions. So this company is also the only DBE certified paving and grading company in the entire state of Nevada. They are the only company in line to get a massive portion of Brightline for paving and grading if they can win it. But they've also got a ton of contracts in there. And what's more important about conditions is we actually have to tie in a little bit of character to this one. So there was a distraught owner who was not making healthy decisions in their personal life. They were also married to one of the other business owners, and that was a very struggling situation. And business owner would just be irate one day and say, nope, vehicles aren't going out. Leave those vehicles there, right? Well, we're not talking about like little trucks here, guys. We're moving dirt, right? We're talking paved, like grading machines. These are all $300,000, $400,000, $500,000 pieces of machine. How much do you think it costs to rent one of those? How much do you think they charge you the day of? 50% extra, just so you know. Yeah, it's brutal. So we had a situation where last year they had a rental expense of like 1.2 million. I met them in like March, April this year. Their rental expense to April was 60,000. Those two don't compute. You're like, wait, we're like 1/10 of what we were last year. Well, unfortunately, that irate owner had passed away, right? And then there was this unique situation that it just was like, hey, we can't get in the assets. We had to rent out, right? But that had been fixed. Then there was another problem, right? They had an estimator that was just giving bad estimates, right? So if you got a salesperson that's giving bad sales quotes, you are dead, right? You are literally throwing money out the door. Well, they identified it, but here's the problem. I told you they had a 12-month sales cycle. So there's like 10 contracts already signed that you're working in that you know you are losing on, right? But we were able to say, hey, this is average because guess what? That last contract ends on this date. And you as an entrepreneur kept such good track records. You showed us every job you bid before that person and every job you bid after them, right? So if you're going to tell a story to the lender, you better have the data to prove it, right? And if it doesn't match in the data, then find someone to talk to and figure out how we tell this story, right? So those were both equal, right? Capital, as I told you, they had none. Like we couldn't even go get an SBA loan because there was no money in the bank. There was no cash injection available, right? But what they did have is phenomenal credit and a whole bunch of equipment, right? So they had like millions of dollars equipment, half of it was paid off. So they had millions of dollars of potential collateral that they could place if need be, right? But in this situation, we ended up refinancing their high debt, paying off lenders, and hiring additional staff, right? And this was one of the more complex ones that I had to get done, in all honesty, because of the fact, like I told you guys, it was a 7-figure negative profit and loss statement. Do you know how many lenders just like, as soon as I said, hey, I want to tell you a story, and it's a really great client, but by the way, they were negative 1.7 million last year. And they're just like, pass, like just pass, forget it, right? So that, the reason I mention that is because the number one thing you need to do of all of this, why have I given you all this information to give you this perspective? Because you need to know how to tell your story and you need to know what the audience is listening to, right? They're listening to these 5 C's. So if you can show them how my character is stronger now, or my capacity is stronger now because I don't have this person bidding my jobs anymore, or because I'm not doing this, and then you can directly tie it to the numbers, like, hey, we're saving this money here. That's line item 16 on my profit and loss. Just look at it this year compared to last year. Look at my payroll last year, right? Like there's so many things that you can show as a business owner to tell your story. And that's the importance of this, right? I want you guys to understand this so you know, where am I strong? Because I'm going to focus on those parts of my story. And where am I weak? And I'm going to make sure I'm going to mitigate those parts. All right. All right. Let's look at another one. So this one, in this case, this was a medical. So again, everybody, like lenders love medical. I can, as soon as you say you're medical, I get like 5 extra lenders that I can float it through just because everybody likes it. Right. But in this situation, so collateral, none. Right. This is a situation that you see a lot in the wealth accumulation world where I don't own anything. Me personally, I don't own anything. There's a whole bunch of family trusts and other things that own all the property, but it just so happens in this case, they're not mine. I've already passed that all on to my children, right? And so it's like, here you are, you pay yourself $15,000 a year. That was his W-2 salary from his income. You don't own a home. You don't own anything. I think he owned 1 car in it, right? And so no collateral whatsoever, right? So severely negative. Capital wise, he had, not as much money as you need in the bank. Let's put it that way, right? Not as many zeros behind as you want. He's very low on capital. He didn't even have enough to meet an equity injection requirement, right? But here's the cool thing. Once you're in business for 2 or more years, you can have an equity injection requirement as low as 0. So his equity injection requirement was 0 because he'd been in business more than 2 years. And so when you're in business more than 2 years and you are looking to expand your business or refinance debt or things of that sort, those are considered business expansion loans, and it has a 0% equity injection. So this person got $500,000 and he just sent them $4,000, or I think his was a little bit higher, but he sent them the fees, right? Like, oh, you're going to charge me $4,000 for this? Cool. Closing day, I'll happily send you the $4,000 because you're going to send me $500,000 right back. I'm cool with that, right? But what worked really well for this customer, right? He had really great credit, right? But this is one of the facades of credit. The credit score alone is not enough, right? Because you have another thing, what's called the depth of your credit profile. So if you have 20 credit cards that have been reporting for 20 years, you'll have a really high score if your debt utilization is low, but you won't have any depth to your credit profile. So when you go to get a home, they'll be like, man, like, you've never had a car loan, you never had the other things, or a business loan, right? They'll be like, okay, we're going to start you small because you've never worked with any type of loan other than a revolving credit. So we don't know what you'll do if I give you 50 grand of cash at once, because you've never had 50 grand of cash, right? And so you have to think of those capacities in it, right? So he had good credit. He had a good reputation. He had clients on retainers. He's in medical. He is actually doing mobile diagnostic testing during COVID. So hitting a need. He was mobile beforehand. So it just like, this is perfect. I'm already doing this, cashing in, right? And then capacity. This is, again, where we got to rely on his capacity. He was claiming 6 figures worth of profits on an annual basis, paying his taxes rather than choosing to write off every single penny he possibly could. And because of that, you paid a lot of taxes, but I'm the one that gets to say, hey, now it's fun, right? Now you can get that done, right? But you have to look and see. So anytime we gauge this out, you say, okay, this one was strong on character, conditions, and capacity. So we rely on that. And then we mitigate the collateral. Like collateral is easy to mitigate because I just say, hey, well, you can't decline us because we don't have collateral, right? But the capital one, we were just fortunate enough to, not require it. But they could have come back and said, hey, we want 15% cash injection if he was using it for something else. Or let's say, like initially we were going to buy equipment and we decided not to. But anytime you want to buy equipment, you have to put 10% down if you go SBA, right? So if you don't have a ton of cash, you're like, well, shoot, I need working capital just so I don't have cash injection. Do you have a question?
A lot.
That's fine. This is I'd love, we could just open it up for questions, right? Because that's the goal. I want you guys to have a good understanding.
Nobody else have questions?
Fire away, hon.
Okay.
No?
I'll let him go.
Okay.
Yeah, so I wanted to ask you, so if I get a credit card for 300, like if I apply for a credit card for 300, am I able to take that out and invest it to like build it up and then like pay like the annual fee back? Like let's say the annual fees.
It will depend on the terms of the credit card, right? So there are plenty of credit cards that'll give you like 0% or something where you could go charge up on it or like take a cash advance off of it or do like balance transfers to your bank account. Where there are credit cards, you can definitely do that, right? This goes back to kind of what we talked about earlier, is that's a very risky transaction, right? Because when you use a credit card to fund a business, it's going to be at a much higher interest rate. So you just have to make sure that you're going to be able to pay that back, including, estimate a 25% interest rate. So if your profit margins are not greater than 25%, that would be a negative cash flow play for you, right? But you can do that. I mean, that's something I'm sure you see it a lot on social media now. They're like, hey, if you've got over 700 credit score, I'll get you hundreds of thousands of financing for your business, right? There's organizations that do that. Just so you know, the credit cards are at 0%. They charge you a fee, right? They have to do what let's say I was to help you with that, then I would have to use my credit card processor to charge all your cards and advance them. And then I'm going to charge you a fee for that because I'm not doing it as a cash advance because then you'll pay interest on the card. So I'm doing it as a purchase through my business, right? And then I think most of them, they charge like 7 or 10%. So if they get you 100,000, you're going to give them 10 G's. And so you only take 9, right? So if you use companies like that, you got to be careful. But for me, I would say don't start there, right? Like build a business plan, see if SBA makes sense, see if there's other options for you. But also, if you're starting a business for less than 50 grand, credit cards are a really great option, right? So, so kind of yes and no. I hope I answered that for you. Yeah. Other questions?
Okay, I wanted to ask based on what you were saying earlier about getting that loan that you were explaining before you did the doctor Cunard that you had. Yeah.
Yep.
Where you were saying that you got them X amount to pay and for them to have.
Yep.
But then they got this loan, let's say I think it was for $250,000 or something like that. So then when it was time to repay, since they had that gap where they didn't have the assets that they needed. They had the asset, but they didn't have the
capacity. They didn't have the income coming in.
Yes.
Yep.
To come in for that, is the interest on that was like really high or no? And then what was the gap for them to pay, when they were paying?
Yeah. So when you get a line of credit, you don't get a gap. You just get your payment's going to be due next month, right? So you have to pay, right?
Okay,
yeah. These were all lines of credit for them. Okay. So we got a bunch of lines of credit and then we use the lines of credit, but you then have to pay your payments typically with the money you borrowed for the first month or so. Like for them, they had revenue coming in like 20 days or 15 days. They knew they had big checks because jobs were finishing, or like they'd already invoiced and they know this company pays on the 1st and the 15th or whatever, right? So they knew money was coming in.
Okay.
We had to bridge like a 2-week gap.
Okay.
But what we did have to do is we had to do that just so they could actually meet the month worth of services and everything. And then we went to go get the SBA loan, and we had to go tell a really fancy story to a really nice lender, right? And we were able to get them to see on board, make sense. And also because CRF USA, they were the lender, they're a mission-based lender.
Mm-hmm.
This is a woman-owned business. CRF prefers to lend to women, minorities, and veterans. In particular, if you are a woman, minority, or veteran, or multiple of those, and you are serving women, minority, or veterans, then you can even have cooler things done. So Aaron was telling this story where when a nonprofit has very healthy balance sheets, right? They have their own on-loan product. They don't offer this much. They don't talk about it because we only do it if we can't fit you an SBA,
Mm-hmm.
right? But the reason I mention that is because if you are a nonprofit and you are set up with a mission that has bylaws to do it, when you have extra profits or you have extra money, then you can make exceptions and say, hey, we're going to do this one. So Aaron was telling me this really cool story about how, I think it was in downtown Minneapolis or downtown Detroit, there was a minority-owned business that was going to be providing services to like minorities in the area, like whether it was like, you know, food services. I can't remember exactly what the company was, right? But she said literally they were like, they had one out of the triangle and everything else was just red X's, right? And they're like, normally this is just not a deal we do, right? But because we've had a really great year, our balance sheet are really healthy, we have more money than we expected as a nonprofit this year. So guess what nonprofits always got to do with their money? They got to deploy it, right? And so in that case, she's like, hey, she even called me. She's like, hey, just so you know, we've got really healthy balance sheet. If you've got some mission-based deals, let me look at them, right? So there are times that they're just like, hey, we're going to go outside the box on this one and get it done, right? And that's something we're looking at right now with, I told you guys that I'm working with an entrepreneur that we met just like a week and a half ago. Now, this is going to be like their 4th company and they're doing books. And it's going to be a little bit more difficult because that's just a hard place to do, right? But from what we've learned of these entrepreneurs so far, they've been successful at other things and they have a business. They're like, our business is mature. It's actually winding down and dying, but it's still producing revenue and profits, right? Like, and they don't have to do anything to maintain it now because it's all automated. It's online. It's from, you know, content creation in essence, right? So I mentioned that because now I get to use that as a story, right? So I go to this lender and be like, okay, yeah, I understand you guys are this. Pull up this YouTube channel and see how many followers are on it. These two did that, right? There is power to your character and your reputation when you can say, yeah, I'm starting a new company, but check out what I did with this old one. Check out the 3 million followers I have on my YouTube channel. 3 million? Dang, let's talk, right? For me, when I told him, I'm like, I literally, I messaged her. I could show you the text message. I said, these entrepreneurs are going to succeed. I said, I don't know. I'm like, I think I said something like, this is just the next business in line of these serial entrepreneurs and they succeed, right? And it's one of those things that it's like, you know, when Elon Musk goes somewhere, do you think they put him through a grill? No, they're like, how, like banks fight for him. Like banks right now are probably hitting up Elon. Can I give you a 500 million billion line of credit? You know what I mean? Because they know he can repay it and they know he's good for it, right? So the businesses always want to try and go after those capacities.
And can you elaborate a little bit about what you said starting the nonprofit, and then you said you were gonna go and lend to the Philippines?
I am, yes. So let's do this just since we're gonna, because I'll stay here and chat as long as you guys want, but let's go ahead for the broadcast since we're kind of getting off topic there.
Oh, okay,
I'm gonna end the broadcast, but we're gonna keep going with questions, right?
Okay.
So I just want to say big shout out. Thank you to everybody that's joined us today. We hope you stayed on a little bit longer. My name is Stephen Ness. I'm with Lyft, and I'm here to help your business get funding so you can keep dreaming.